Key performance indicators are the numbers that you track in the business to see how you are going. So we're normally talking about trends here. So comparing from one period of time to another, whether it's weekly, monthly, annually, quarterly even, or over a period of years. So your KPIs or your key performance indicators are those things that you're tracking that are important to your business right now and potentially into the future. So I've got a little graph in the workbook, more like a mind map rather than a graph, of all the different types of KPIs that you could actually track. Now, it's going to be a waste of time to track all of them, and some of them may not even be relevant to your business. So it's important to figure out what's important to track right now, to spend a bit of time to see what's going on in the business, to see what improvements you can make to tweak that KPI, and then just monitor it to see what's happening. So I'm going to run through some of the definitions and how to calculate and what to look for in particular for some of these KPIs. I'm going to start at the top left and work my way around, and start at the top right and then work my way around. So trends, tracking trends. Is your money going up? Is your money going down? Is your income going up? Are your expenses going up? And over what period of time? So I like to use the multi-period profit and loss spreadsheet or profit and loss report in your accounting software, so in your bookkeeping package, to see what's happening on a month-by-month basis. So one of the really easy ones to explain is rent. If you're paying rent by the month, then on your rent line item, it should be the same amount every single month. And if it isn't, then what's going wrong with the trend? So have you bunched it up and paid a bit in advance, or was it paid late and so you've got 2 payments of rent in 1 month and then 0 the month before? So looking at what's happening by looking at the reports and analysing those trends can help you figure out what things you need to look at further on and make sure it doesn't happen if it's something that you don't want. Okay, jargon, hate jargon. EBIT and EBITDA. EBIT is earnings before interest and tax, and EBITDA, earnings before interest, tax, depreciation and amortization. So we're essentially talking here cash and non-passive income. So the actual earnings from your business. So what money came in, what money went out, what's your profit, excluding interest, excluding tax, excluding depreciation and amortization. So if you didn't have all of the accruals in the business, and I'll use the word accruals, and hopefully you've watched the profit and loss one and know what an accrual is now, you're taking out all the book entries essentially to work out what your profit is from a cash point of view. Now, if you're using Xero or if you're using Mob, you may be able to run a cash report which excludes those things anyway. And what we're looking for is taking out the tax deductions and seeing really where the business is at from a cash point of view. The next one is your spend versus income. Now, I like comparing this over years rather than months. Spend versus income is good for cost of goods sold over months sometimes, but generally I look at it on an annual basis. And the reason for this is because if your business is growing significantly or if it's shrinking a bit from an income point of view, then your numbers on your expenses will be significantly different from the year before. So how do you know whether you're making changes to your costs effectively if you're not comparing it as a percentage? So the easy way to calculate this is to get the expense amount and divide it by the total income amount. Now, I like doing this for things like advertising, for wages, for overheads in general, insurances. What are those big costs that you're spending, and how is that as a percentage of income? And are you happy with that as a percentage of income? The next one is your cost of goods sold. So what's your gross margin? When we look at how much you've spent in order to sell and make an income, that's your gross margin. Now, there is a little bit of a difference between your gross profit percentage and your markup. So if you're adding a markup, then it's not the same percentage as your margin. There's a little bit of maths involved. But essentially it's like this. If you sell something for $100 and it costs you $25, your markup is 3 times, so 300%. So you bought it for $25, you're going to sell it for $100. Actually, it's 4 times, isn't it? Whereas your gross profit is $75. So $75 divided by the $100 of sales is 75%. So our markup is 4 times, so 400%, but our gross profit margin is 75%. So for every dollar that we spend, we get to keep 75% of it. Now this is just a generic percentage. It's not necessarily right for your business, but it's just an example. So figure out in your industry and your business what is the correct markup average, and also what the percentage overall of your cost of goods sold or your gross margin. And then check it from the previous year and the previous year and see if it's changed. If the profit margin has gone up, then your prices are increasing or you're getting better deal for your purchase amount. If your percentage is going down, then you're not putting your prices up as fast as what your suppliers are, and you'll need to make a difference there, make a change. Now, the next one is how quickly your customers pay, which are your debtors days. Now, this one can be put on a little bit of a time frame. So if you're sending out an invoice today, then how many days from when you send that invoice to when your customer actually pays you? Is it the same day, like a retail store where you walk in, you can't leave the store with your stuff until you pay for it? Or are you sending an invoice out and having to wait and then having to chase and having to collect? We can squash that down and get that smaller, the better your cash flow is going to be for your business. So one of the things that you can track is your debtors days. Now, depending on your software, it may form part of the reporting that's already hidden in the reporting or the analytics section of your program. And I'm intending to do a different video, a live video for this one, because looking at the analytics in your programs is a lot of fun. On the flip side, not just do we track how quickly your customers pay, but we can look at how quickly you're paying your own bills as well. And by evening them out and making sure that you're not spending your own money to pay for bills can mean that you're going to hold more cash in your bank account. Sounds weird, doesn't it? So if your debtors or your customers pay you in 10 days, but you're paying your bills in 3 days of receiving the bill, then you're out of pocket for 7 days. So there's that difference between you spending the money and then you receiving it a few days later. So what we want to do is try and get them as close as possible. Now, that might mean you have to squish in your customers and pull out your creditors. You've got a choice. You don't have to pay your bills as soon as you receive them. And technically, if you paid them on the due date, that's the date that the person who's asking for the money is expecting it anyway. So why pay it early when you can keep the money in your account until that due date? The next couple of KPIs is around customers. So how much do your customers actually spend? Now, if you've got point of sale software, then you may have a good understanding of how many customers you've got walking through the door every day, week, or month. If you don't, then you may be able to add up how many invoices you have generated over a period of time. Then it's getting that number of customers and working out how much income in the same period of time and doing the little division. So how many customers, how much income gets you to $1 value customer spend. Easy, right? Sometimes you don't know how many customers you have. Like I said, it could be invoices, but sometimes not all of your customers are buying things from you either. You might also want to track how many new customers you're getting if you want to increase your customers, how much each customer spent on a customer per customer basis, and how many times your customer spends every year. So for big stores who are just collecting cash, ringing it in, ringing it out, you may not know all of these detailed customer information. But if you've got a rewards card setting, or if you're sending an invoice out for every single customer and you're tracking your customer names, then it can give you a better understanding of what your customers are earning, are spending, and what they're worth to you. And maybe you might do a little good deal for them once every now and then and make them an even more loyal customer for you. Then we've got our stock turnover and our inventory days. And we've talked about this one I've run through a little bit of that in the workbook around how many days your stock actually sits on your shelf. You buy it, how long does it take to then sell it? If you've got a business with a really quick turnover, so for example, it might be food or consumables that you're selling, you don't want that to sit on your shelf for 3 years, then your inventory turnover will be quite quick. You want to sell it and then buy more and sell it and buy more and sell it and buy more, which means your cash is moving quite quickly through your business. On the flip side, you might stock specialty items and have them sitting on the shelf for a year. Well, when you're looking at your shelves, have a think about this. For every single thing that's on your shelf, that dollar or multiple amount of dollars that you spent on that item is sitting there waiting to be sold. The cost that you spent on it is what's sitting on the thing, but the opportunity to sell it at its market value or its retail value is even higher. If you've got stock that you don't need, get rid of it. Cash it in somehow. Worst case scenario, the worst that you can do with your stock that's not selling is throw it in the bin. And that will clear up the space on your shelves for something that people might actually buy. But if you can sell it for $2 or $10, it's money in your pocket that wasn't in your pocket before, was sitting on the shelf waiting for somebody to walk in and buy it. So if you've ever wondered why businesses hold discounts or sale days or anything like that, it's to get rid of the old stock that they can't sell. Sometimes the customers buy good stuff as well when they're in here looking for a bargain. The last percentage on the left-hand side is percentage of tax paid. Now, we've worked out with your profit first percentages what your percentage of tax paid is. And sometimes you can change this, but most of the time you can't. I'm going to stop this recording and put another one in so that we can go through the ones on the right-hand side.